Have you ever looked at your own financial life and quietly wondered whether you are ahead or behind? Not in the abstract way people talk about money at dinner parties. I mean the private version of that question, the version that shows up when you are awake at night thinking about your bank account, your retirement balance, your debt, your future, and the uncomfortable possibility that other people may be doing better than you are. You see someone online taking a vacation, buying a new car, moving into a bigger house, or talking as if money is not a source of pressure in their life, and a part of your mind starts making comparisons. You ask, how are they doing that? Are they actually wealthier than I am? Are they building something I am not building? Or are they simply better at presenting a picture that is not supported by the underlying numbers? That question matters because in money, as in markets, the surface can be very misleading. A person can look financially strong and still be fragile underneath. A person can drive a new car and have no real savings. A person can live in a large house and be one missed paycheck away from a forced sale. A person can earn a decent income and still be losing the long game because their system is wrong. So today I want to pull back the curtain and look at what the average person's financial life actually looks like. Some of these numbers may make you feel better, some of them may make you uncomfortable. But discomfort is useful when it tells the truth. The goal is not to make you feel superior to the average person. And it is not to make you feel ashamed if you are behind. The goal is to give you an accurate map, because without an accurate map you cannot make good decisions. In my experience, most bad financial decisions come from not understanding reality clearly. People confuse income with wealth. They confuse a payment. They can survive with an asset they can afford. They confuse a good credit score with financial strength. They confuse being normal with being safe, but normal and safe are not the same thing. In fact, when the average financial behavior is weak, being normal can be very dangerous. That is the first principle I want you to hold in your mind. Average is not a target. Average is a warning label. When you understand what the average person earns, spends, saves, borrows, and retires with, you can see the machine more clearly. You can see where the pressure points are. You can see why so many households feel rich for a short period and poor for a lifetime. And you can see what needs to be different in your own system if you want a different result. Let us begin with income, because that is where most people begin when they judge themselves. They ask, how much do I make? That is the most common question. And it is also one of the least complete questions still. It matters. The most recent numbers show that the median full-time worker earns just over $1,000 per week. That comes to roughly $52,000 per year before taxes. That is the individual worker, not the household, not a married couple combining two incomes, one full-time worker. Near the middle of the American income distribution, if you make about $26 per hour, you are around that middle point. Half of full-time workers earn more, half earn less. Now, $52,000 can sound respectable until you run it through the real world. Federal taxes come out. State taxes may come out. Social Security and Medicare come out. Health insurance may come out. Retirement contributions may come out if the person is saving it all, depending on where that person lives. That $52,000 may become $35,000 to $40,000 of take-home money. And that is where the system begins to tighten, because income is not wealth. Income is input. Wealth is what remains after the system has absorbed its costs. A person earning $52,000 and spending $51,000 is not building wealth. A person earning $40,000 and saving $5,000 is moving in a better direction. This is why I care less about the income number alone and more about the gap between income and spending. The gap is where freedom is created. The gap is where options appear. The gap is where compounding begins. Without the gap, even a high income becomes a treadmill. With the gap, even a modest income can become the beginning of a strong system. So income is only the first layer. The next layer is what people are doing with that income. And the first place where the picture becomes uncomfortable is retirement. The median amount Americans have saved for retirement is about $65,000. At first, that might sound like something. It is not nothing. But when you understand what retirement actually requires, $65,000 is not financial security. It is a small cushion against a very long future. And even that number is too generous as a picture of the whole population, because roughly 1 in 4 Americans has no retirement account at all. 0. No IRA. Number 401k, no workplace retirement plan, no private retirement savings vehicle, nothing. That means a meaningful portion of the population is effectively planning, whether consciously or not, to rely almost entirely on Social Security, family support, part-time work, or some combination of all three. That is not a plan. That is a dependency structure. And dependency structures are fragile because they rely on outside forces behaving well. They rely on government programs staying solvent enough. They rely on family being able and willing to help. They rely on the body being capable of working longer. They rely on luck. And luck is not a strategy. Now, the retirement numbers vary by age, as you would expect. People under 25 have less than $2,000 as a median retirement balance. That is not shocking because many are just starting. In the 25 to 34 group, the median balance is around $14,000. That is better, but still thin. These are people who may have been working for several years already. They may be buying cars, getting married, having children, renting, taking on mortgages, paying student loans, and beginning the most important compounding decade of their lives. A $14,000 retirement balance at that stage does not mean failure, but it does mean the system has not yet produced much momentum. Then look at the group that should make everyone pay attention. By age 65 and older, the median retirement balance is around $88,000. $88,000 sounds like a meaningful sum when you see it on a bank statement. But retirement math is not about how big the number looks. It is about the income that number can safely produce. Using the old 4% withdrawal rule as a rough guide, $88,000 supports about $3,500 per year. That is less than $300 per month. Sit with that for a moment. After decades of work, the median older household with retirement savings may be able to draw less than $300 per month from that retirement pool if it wants to avoid exhausting it too quickly. $300 per month does not fund retirement. It may not even cover groceries, utilities, prescriptions, insurance gaps, property taxes, home repairs, or the basic costs of maintaining a modest life. That is why the average person's retirement picture is so fragile. Not because people are bad, not because they are lazy, but because the system they followed did not produce enough surplus, did not begin early enough, did not compound long enough, and often got interrupted by debt consumption, emergencies, and poor financial sequencing. This is where many people say, but what about Social Security? That is an important part of the picture. The average monthly Social Security benefit is around $1,550. That is about $18,600 per year. For some households, this is a lifeline. For many retirees, it is the foundation. But the foundation is not the whole building. $18,600 per year can be meaningful if you have a paid-off house, low medical costs, no dependents, no debt, and a very controlled lifestyle. But if rent is rising, medical costs are unpredictable, insurance premiums are increasing, property taxes are climbing, or family members need help, that amount can be stretched very thin. And remember, it is an average. Many people receive less. If you had years of low earnings, years outside the workforce, or an inconsistent work history, your benefit can be lower. This is why some disciplined people plan as if Social Security will be a supplement, not the engine. They do not ignore it. They do not assume it will disappear. They simply do not let their entire retirement system depend on one public program. That is a more robust way to think. When I look at systems, I ask, what happens if one assumption is wrong? What happens if the benefit is lower than expected? What happens if inflation is higher than expected? What happens if health expenses arrive earlier than expected? What happens if retirement lasts longer than expected? A good financial life is built to survive imperfect outcomes. The average financial life is often built only for the base case. That is why it breaks. Now let us move from the future to the present. How much does the average household actually spend? The number is around $5,577 per month over a year. That is roughly $67,000 in total spending. This is the number that reveals the gap problem. If a household spends $67,000 per year, it needs to bring home at least that much just to break even. Not gross income, home income. And if it wants to save, invest, reduce debt, and build a margin of safety, it needs to bring home more than that or spend less than that, preferably both over time. When you look at the categories, you see why it is so hard for many households to move forward. Housing is the biggest item. The average household spends about $1,885 per month on housing. That includes rent or mortgage payments, property taxes, insurance, utilities, and maintenance. That is more than $22,000 per year just to keep shelter in place. And in many major cities, that number feels low. In expensive markets, $1,800 may not buy much at all. But even at the average, housing takes a large bite out of the system. Then comes food. The average household spends around $691 per month on groceries and dining out. That is more than $8,000 per year to keep the household fed. Food is necessary, but food spending also reveals habits. A household that eats out frequently, buys convenience constantly, and does not pay attention to recurring waste may not notice the leak until it becomes a flood. Transportation is another major drain. The average household spends around $913 per month on transportation. That includes car payments, insurance, gas, maintenance, and public transportation. Nearly $11,000 per year just to move from place to place. Housing plus transportation together often determine whether a household has room to build wealth. If those two categories are too large relative to income, everything else becomes constrained. Savings get squeezed, retirement gets delayed, credit cards become bridges. And once credit cards become bridges, they often become traps. This is one of the most important realities behind the average person's financial stress. The problem is not usually one single catastrophic decision. It is a system of ordinary decisions that leave no margin: a slightly larger house, a slightly newer car, a few subscriptions, a pattern of eating out, a vacation financed because we deserve it, a credit card balance that never quite returns to zero. Each decision may seem reasonable in isolation. Together, they form a machine that consumes the gap where wealth should have been created. Now let us talk about credit scores because this is where many people receive a misleading sense of comfort. The average FICO score in America is about 715. That is considered good. It means many people are paying bills on time and managing credit well enough to look acceptable to lenders. A good credit score is useful. It can lower borrowing costs, it can improve access, it can make mortgage rates and car loan terms better. But a good credit score is not the same thing as wealth. You can have a good credit score and no emergency fund. You can have a good credit score and too much mortgage. You can have a good credit score and large car payments. You can have a good credit score and retirement savings that are badly behind. This is a subtle but important distinction. The credit score measures whether the system can trust you to borrow and repay. It does not measure whether borrowing is making you freer. It does not measure whether your future is secure. It does not measure whether your assets are growing faster than your obligations. So use a good credit score as a tool, but do not worship it as a report card for your whole financial life. The stronger measurement is still net worth, cash flow, liquidity, and the direction of the trend. This brings us to the elephant in the room, credit card debt. The average household is carrying more than $9,000 in credit card debt. That is not mortgage debt backed by a home. It is not a business loan tied to productive assets. It is often consumption debt tied to things that are gone, forgotten, eaten, worn out, or sitting in a closet. And the interest rates can be brutal, 15%, 20%, 20%, 25% or higher at 20% interest. $9,000 of credit card debt costs about $1,800 per year in interest. That is $1,800 that does not buy food, build retirement, increase freedom, repair a home, educate a child, or create an asset. It simply transfers income from the household to the lender. That is why I view high-interest consumer debt as one of the most destructive forces in personal finance. It reverses compounding. Instead of your money earning returns for you, your past consumption earns returns for someone else. That is a terrible trade. And once people are in that structure, they often underestimate how much of their life energy is being drained by it. Every payment feels like progress, but a large portion is simply interest. Every month they carry the balance, the future gets a little more expensive. The math is unforgiving. If you are earning 7% in the stock market while paying 20% on credit cards, you are not getting ahead in a rational way. You are standing in a leaking boat and polishing the steering wheel. This is why high-interest debt usually deserves to be attacked before most investing beyond the most obvious guaranteed matches. Paying down a 20% debt is equivalent to earning a guaranteed 20% return. Very few investments can compete with that on a risk-adjusted basis. So when I look at the average person carrying credit card debt, I do not see a moral failure, I see a system failure. The system allows and encourages people to pull tomorrow's income into today's consumption at extremely high interest rates. The solution is not shame. The solution is to stop the compounding from working against you. Now, the broadest single measure of financial health is net worth. Net worth is what you own minus what you owe. Add up the value of the home, the cars, the bank accounts, the retirement accounts, the investments and other assets. Then subtract the mortgage, credit cards, student loans, auto loans, personal loans, and other obligations. What remains is net worth. The median net worth for American households is about $122,000. Again, that number needs context by age. The picture is very different. For households under 35, median net worth is less than $14,000. That may not be alarming for a 25-year-old who just started working. But for someone in their mid-30s with little progress, it should be treated as a signal. Signals are not insults. Signals are information. The 35 to 44 group has a median net worth around $91,000. The 45 to 54 group is around $168,000. The 55 to 64 group reaches about $212,000. The 65 to 74 group is around $266,000. These numbers can produce two reactions. One reaction is relief. If you are above them, you may feel you are doing well. The other reaction is concern. If you are below them, you may feel behind, but I want you to think deeper than comparison. Ask what the numbers imply about behavior and time. These levels are not impossible to beat. In many cases, a person with decent income, controlled spending, low debt, and consistent investing can do substantially better than the median without being a genius, without timing the market, and without building a unicorn company. That is the important part. Most personal finance does not require extraordinary intelligence. It requires ordinary discipline applied for an extraordinary length of time. The average person's problem is not usually that the rules are too complicated. It is that the simple rules are ignored because they are boring, delayed, and not socially rewarded. Spend less than you earn. Avoid high-interest debt. Save more than average. Invest consistently. Do not panic. Let time work. Those principles sound simple. They are simple. But simple is not the same as easy. The system is filled with temptations designed to break them. Now look at the savings rate. Americans save about 6% of their after-tax income, 6%. That means if someone takes home $4,000 per month, they are saving about $240. That is better than nothing. But it is not enough to build substantial freedom unless income is high, costs are low, or the time horizon is very long. And remember that 6% may have to cover everything: emergency funds, car replacement, home down payment, vacations, repairs, retirement, college savings, medical surprises. If 6% is being divided among all those claims, very little may actually reach long-term wealth building. This is why the average person can feel like they are saving and still not move very far. The savings rate is too thin. It is trying to support too many objectives. For retirement alone, many planners suggest 10 to 15% of income. And if someone wants to retire early or catch up after a late start, the number often needs to be higher. So if the average savings rate is 6% and the average retirement balance is low and the average credit card debt is high, the story becomes clear. The average system is undercapitalized. It does not have enough surplus. It carries too much expensive debt. It starts compounding too late, and it depends too heavily on external support at retirement. Again, this is not a criticism of people. It is a diagnosis of the machine. If you want a different outcome, you need a different machine. Now consider retirement age. Many people assume 65, but the average retirement age is closer to 61. That sounds good at first. It sounds like people are leaving work earlier than expected, but the surface hides the problem. Full Social Security benefits are often not available until around 67, depending on birth year. So if someone stops working at 61, there may be a 6-year gap before full benefits. That gap must be funded somehow. If the person has large retirement savings, that may be manageable. If they have only the median balance, it may be extremely tight. And not everyone retires at 61 because they planned it perfectly. Some people retire because of layoffs, health problems, age discrimination, caregiving obligations, burnout, or industry changes. The official retirement age may be a choice on paper, but in real life, it is often a collision between personal resources and physical reality. This is why planning to work forever is risky. You may want to work, you may be willing to work, but the market, your body, or your family situation may not cooperate. A robust financial system does not assume you can always sell your labor at the same rate forever. It creates assets so that over time, the dependence on labor declines. That is the real purpose of investing. It is not entertainment. It is not stock picking as a hobby. It is not bragging rights. It is the process of turning labor income into asset income so that your future is less fragile. Now consider the length of retirement. Someone who reaches age 65 can often expect to live another 19 to 21 years. If a person retires at 61, that can mean 25 years or more of retirement to fund. 25 years is a long time. It is a full generation. It is longer than many mortgages. It is long enough for inflation to cut purchasing power dramatically. It is long enough for health conditions to change. It is long enough for markets to go through multiple cycles, and it is long enough for a weak retirement plan to be exposed. The problem is not that people live too long. Living longer is a blessing. The problem is that many people fund a long retirement with numbers suited for a short one. That is a mismatch, and mismatches are where financial pain usually appears. You see this in banking. Short-term liabilities and long-term assets create fragility. You see it in households. Long retirement needs and small retirement balances create fragility. You see it in government. Long promises and insufficient funding create fragility. The pattern repeats because the underlying principle is the same. Promises must eventually meet resources. If the resources are not there, the system has to adjust. The adjustment can come through lower spending, delayed retirement, family support, debt, inflation, or reduced living standards. But the adjustment comes. That is why knowing the average numbers matters. It shows you the path that many people are currently on, and once you see where that path leads, you can decide whether to stay on it. Now here is the empowering part. Doing better than average does not require doing something magical. It requires doing the obvious things more consistently than average people do. If the average savings rate is 6%, saving 10, 15, or 20% puts you on a different trajectory. If the average household carries credit card debt, paying your card in full each month puts you ahead. If the average person has thin retirement savings, contributing every month to retirement accounts puts you ahead. If the average household lets housing and transportation consume the entire gap, keeping those costs controlled creates a structural advantage. If the average person reacts emotionally to markets, staying systematic creates an edge. None of that is glamorous, but it works because the financial lives of most people are weakened by unglamorous leaks. Too much car, too much house, too much convenience spending, too much credit card interest. Too little saving, too little investing, too much delay, too much comparison, too much faith that things will work out. The way to beat average is not to become brilliant. It is to stop doing the average things that destroy compounding. Think about a household that spends $5,500 per month. If that household can live well on $4,500 per month, it has created a $1,000 monthly gap that is $12,000 per year invested consistently over decades. That gap can become a major asset base, not because the person predicted the next hot stock, not because they were lucky, because they changed the structure. The structure matters more than the drama. The same is true with income. If the median worker earns around $52,000 per year, earning a little more helps. But earning more only helps if the increase does not get immediately absorbed by lifestyle inflation. Many people get raises and remain broke because the system expands to consume the raise. A better pattern is to let income grow while lifestyle grows more slowly. That creates widening surplus. Surplus creates investment. Investment creates asset income. Asset income creates optionality. Optionality creates freedom. That is the chain. Break the chain at any point and the result weakens. Now, what should you do if you hear these numbers and feel behind? Do not panic. Panic produces bad decisions. The first step is to know your own numbers, not vaguely, precisely. What is your income after taxes? What is your monthly spending? What is your net worth? What is your retirement balance? What is your savings rate? How much high interest debt do you carry? What is the interest rate? How much does housing cost as a percentage of take? Home pay? How much does transportation cost? What are you investing every month? What would happen if your income stopped for 3 months? These questions are uncomfortable because they remove the fog. But fog is not protection. Fog is what allows drift. Once you know your numbers, you can begin to change the system. If you have credit card debt, attack that first with seriousness. Not casually, not with whatever is left, with a clear plan. If you have no emergency fund, build a small one quickly so every minor surprise does not become new debt. If you are not getting an employer match in a retirement plan, understand whether you are leaving free money on the table. If your savings rate is below 6%, get it above average, then above 10, then as high as your life reasonably allows. If your housing and transportation costs are suffocating the gap, recognize that the problem may not be your coffee. It may be the large fixed expenses that were normalized by the culture around you. The culture sells payments. A sound financial system measures total cost and opportunity cost. Those are different worlds. Now, if you are already ahead of the averages, do not let that make you complacent. Being ahead of a weak average is not the same as being secure. If the average retirement balance is inadequate, being a little above it may still be inadequate. If the average credit score is good but the average net worth is low, a good credit score is not enough. If the average person saves 6%, saving 7% may technically beat average while still falling short of what your future needs. Your goal is not to beat a struggling crowd by a few inches. Your goal is to build a system that is robust enough for your life. That requires looking at the future. Honestly, your desired retirement age, your health risks, your family obligations, your location, your spending preferences, your tolerance for volatility, your income stability, your time horizon, your ability to keep going when markets are down. The average number gives you a benchmark. It does not give you the finish line. That is why I keep coming back to principles. Principles protect you from being dragged by comparison. A principle says, I will not carry high-interest consumer debt unless there is no other choice. A principle says, I will maintain liquidity so emergencies do not become debt. A principle says, I will invest consistently before lifestyle consumes the surplus. A principle says, I will measure wealth by net worth and cash flow, not appearances. A principle says, I will not let social media tell me what financial success looks like. A principle says, I will not confuse looking rich with becoming free. These principles matter because the average person is surrounded by false signals. The new car looks like success. The vacation looks like freedom. The upgraded house looks like progress. The expensive dinner looks like abundance. But without the balance sheet, the cash flow, and the savings rate, you do not know what you are seeing. You may be looking at wealth. You may be looking at debt. You may be looking at a person who is financially secure. You may be looking at a person who is one disruption away from panic. External appearances are bad data. Numbers are better data. Behavior over time is the best data. When you look at the average financial statistics, you can see that many people are not failing in a dramatic way. They are drifting. They earn an average income. They spend an average amount. They save an average percentage. They carry an average credit card balance. They retire at an average age with an average balance. And then they discover that average is not enough. That is the warning. Average behavior produces average outcomes. And in a world with inflation, long retirements, high healthcare costs, expensive housing, and volatile labor markets, average outcomes can be very fragile. So I want you to use these statistics differently. Do not use them to compare your ego. Use them to design your system. If you are below average, use the numbers as a wake-up call, not a verdict. If you are average, understand that average may not get you where you want to go. If you are above average, ask whether you are above what matters, not just above what is common. The real question is not, am I doing better than other people? The real question is, am I building a life that can handle what is coming? That is a more useful question. Can your life handle a job loss? Can your life handle a recession? Can your life handle a car repair without debt? Can your life handle medical costs? Can your life handle inflation? Can your life handle a 25-year retirement? Can your life handle helping family without destroying your own foundation? Can Can your life handle market volatility without panic selling? If the answer is no, the solution is not shame. The solution is design. Design the cash reserve, design the debt payoff plan, design the savings rate, design the investment process, design the spending boundaries, design the rules that protect you when emotion gets loud. That is how financial strength is built, not through one heroic decision, through a system that repeats good decisions until they compound. Let me make the central point as clearly as I can. The average person is not in as strong a position as many people assume. The average worker earns around $52,000 before taxes. The average household spends around $67,000 per year. The median retirement balance is about $65,000. A quarter of Americans have no retirement account. The median older saver may have around $88,000, which can produce only a few $100s per month under a conservative withdrawal framework. The average Social Security benefit helps but does not create luxury. The average household carries thousands in credit card debt. The average savings rate is thin. The average retirement age creates a gap before full benefits, and retirement may last decades. Those are the facts in the mother draft, and they point to one conclusion. The average financial path is not built for freedom, it is built for survival with stress. But you do not have to follow it. You can decide to build differently. You can decide that your savings rate will not be average. You can decide that credit card companies will not collect interest from your future. You can decide that the car payment will not become the reason your retirement account stays small. You can decide that a raise will increase your surplus instead of your lifestyle. You can decide that your net worth will matter more than what neighbors think. You can decide that every dollar has a job, and some of those jobs are to buy back your future time. The choice is not always easy. Life is expensive. Families need help. Housing is costly. Health problems happen. Jobs change. Markets fall. But difficult is not the same as impossible. And once you understand the average, you understand that the bar for doing better is often lower than people think. You do not need to be perfect. You need to be consistently less self-destructive than the average system. That alone can create a large difference over time. A few percentage points more saved, a few bad debts avoided, a few major lifestyle traps rejected, a few decades of investing allowed to compound, a few panics survived without selling. That is how the curve bends. That is how ordinary income can become extraordinary stability. That is how a person moves from financial anxiety to financial control. So if these numbers hit close to home, do not turn away. Look at them directly. The numbers are not there to punish you. They are there to wake you up. They show you what happens when people let the default setting run their financial lives. The default setting is consumption first, saving later, debt first, assets later, appearances first, net worth later, comfort. Now consequences later. That default setting has produced the average results we just walked through. If you want a different result, you need a different default. Assets first, margin first, debt control first, savings rate first, long-term thinking first, reality first. That is the principle. Because the average person's money life is not a mystery. It is the visible result of repeated choices inside a system that rewards consumption and punishes delay. Once you see it, you can stop drifting inside it. You can take control of your own system. And that is where the real change begins. Not when you compare yourself to the average person, but when you decide that average will not be your destination.